Hello everyone, welcome to our video podcast. In this special edition, we are talking about the Union Budget 2026 and more importantly, how it affects your finances, what it means for your finances. Today we have a joint discussion with Vishal and myself Shalini, founders of PlanAhead Wealth Advisors. Welcome Vishal.
Hey, Shalini.
So let's start off with the broad picture first. What do you think, how should investors interpret the macro environment around which this budget is being set?
So I think we are in a great place as far as the macro environment is concerned. While there's a lot of people who are worried about the depreciation that the INR has seen against the US dollar, if you look at the fundamental picture, we are actually in a very good place. Inflation is at a historic or close to historic low at this point in time. We are expected to be at about 4% inflation, and we understand how big the impact of inflation is in terms of investors achieving or not achieving their financial goals. We do expect a little bit of a bump up in inflation numbers when the new series comes out in February. But even then, the possible impact is going to be anywhere between 0.2 to 0.5%, which is still very healthy. We have a government which is very focused around the fiscal deficit. So unlike the rest of the world where debt is a serious problem, we are seeing a gradual movement happening towards a lower fiscal deficit. The target in this budget is now 4.3% of GDP. Debt to GDP ratios, which are targeted to go down to about 50% plus or minus 1% by financial year 2031. We are on that path as well because we've seen a debt to GDP number come down. So I think all in all, growth has been strong as well additionally. So a lot of people who worry about nominal growth numbers are probably missing the fact that real growth is strong at about 7%. It's more the impact of inflation, which is showing up on nominal growth numbers rather than just the fact that growth has slowed down. So generally, we think, we're in this place where I think a lot of people have probably missed the fact that our economy now does not require big bang announcements, especially in the budget, because those can happen outside.
Also,
And now just needs to focus around keeping the financial health that has got built post the COVID years on track.
right. So as you said, macro looks good, but there was some expectation. I think a lot of investors had. We heard in the market about long-term capital gains, which did not come through. So what should investors do as regards equity allocations in their portfolios, either existing or new?
So I think the math that the government had would not have really permitted a capital gains reduction. I think what people have missed is that a lot of readjustment around taxes actually happened in the last budget. And there's been a lot of stimulus measures that have got announced in the last 12 months since then as well. So the government finances did not really allow a tax reduction to really take place as much as people may have wanted it or expected it. And therefore, I think this is a classic case where the expectation was built on hope rather than the mathematical numbers being able to support that. I think one thing has been reasonably clear over the last few announcements that what the government is trying to do here is trying to move in a particular direction where they were trying to simplify taxes, standardize them across asset classes, try to get holding period standardized. So a 1 year reduction in capital gains rate because of the situation that foreigners are now selling and leaving India would have actually distorted the whole bigger picture, and therefore it was a prudent thing in our mind not to increase those or decrease those capital gain rates because it would have just made it all messy across asset classes all over again.
Yeah. But so given that that did not happen, how does equity still have a place in portfolios? What would be your thought?
So our view is that there's been two things that have got focus. One is this lack of capital gain reduction. The second is the introduction of STT, the enhancement on STT rates, the security transaction tax rates on futures and options, right? Now, you have to think about it that for most investors who are long term and who don't trade, the impact of some of this is very marginal. We believe that this is more relevant for people who trade heavily, whether they are high frequency traders internationally or they are local traders. And therefore, investors do not need to worry about these kind of things. I think what you need to focus on really here is saying that what is the outlook on equities in terms of earnings of companies. And typically that's where the attention for investors needs to be, that through the actions that have happened in the budget and outside of the budget, is the earnings growth likely to get better for companies? And corresponding to that earnings growth, how do valuations look like at this particular point? So one of the things that has continuously been happening over the last 12, 18 months is mid and small cap valuations have been quite excessive, and earnings growth has not justified those kind of valuations.
Valuations, right.
Relatively, large caps have been in a better place. Earnings growth has been stronger, and the valuations have also been lower. So our view is that for most equity investors, they need to be mindful that as far as the India investments are concerned, they need to continue to be focused on the large cap side where things are better in terms of earnings, and be mindful that mid and small cap needs to be done gradually. The one thing that they need to be mindful of though is that the international markets have substantially outperformed India in the last 12 months or so. And there is a tendency as a result to chase the international return, saying that this return that was high in the last 12 months will continue in the future.
Right.
And we need to be mindful that while 1 year ago valuations overseas were better in many cases than in India, that's not the case anymore. And therefore, when you decide to make a shift, be mindful about the valuation story internationally as well.
Right.
And don't go overboard chasing the last 12-month returns.
Understood. So what we understand is that even though past returns may look very, very attractive, I mean investors have to be careful not to be swayed by it. Having said that, given the budget announcements or the current scenarios, are there any particular sectors you think that stand out in this environment?
Yeah, so we think there were two sectors that probably need to be looked at very carefully. One is the banking and financial services. So the immediate impact on banking and financial services was negative because of the STD increase. But if you actually step back a little bit and think about it, what has really happened, right? So you're seeing that credit demand has picked up, which is why credit deposit ratios are very, very high at this point in time. You're seeing NPAs have reduced. You're seeing growth is looking strong. There was an announcement around, banking sector standing committee to be set up, which will probably go out and talk about long-term reforms in the space, including PSU bank consolidation. So our belief is that if growth is going to get an impetus going forward, banking and financial services are actually a good place for investors to participate in from a tactical perspective. The other big sector which has got no attention has been IT and IT services, because people have been very sort of uncomfortable with the growth slowdown internationally, lack of policy uncertainty, etc.
Yeah, some bit of geopolitics as well.
Absolutely, some bit of geopolitics. But there is certainly a shift that has happened where, AI has become far more acceptable across the system. And I think a lot of these companies will have a big role to play in terms of how that AI adoption can be done by enterprises. And therefore, like what happened with cloud computing, where, the initial conversation was about how this may be negative for businesses, I think you will see IT services companies start to move in that direction and being able to help enterprises build their AI strategy going forward. And valuations have also corrected back to a much lower level. So we think that both these sectors are actually good in terms of a tactical perspective. You need to be mindful though that, you can never call a bottom. So there could be certain corrections that will continue to happen, but I think you need to be mindful of just the opportunity available here.
Great. So, this brings me to my next point of discussion. A lot of us would have understood the government gross borrowing program, which has got announced at 17 trillion. It is a jump, that we are seeing. So how should investors now look at fixed income? Should they be concerned with this 17 trillion number, or how would it affect fixed income going forward?
So it's definitely been a surprise. I think the markets were expecting about 16 lakh to 16.5 lakh crores. So the fact that it came to over 17 lakh crores is a dampener. Though the net borrowing numbers don't look as bad.
As bad, yeah.
So I think what is being expected is that there will be some sort of management of all of this by the RBI. And I think the RBI has done a fairly good job over this over the last 12 months and longer as well, in terms of ensuring that the government borrowing program is not disruptive for the bond markets. So we have a credit policy coming up soon. We'll wait for how that comes in. But generally, I think what it does for investors is sort of makes them want to tilt more towards the short to medium term duration strategies rather than going towards long term strategies, because this pressure could actually show up more on that side, especially because demand as well on that side has come down a little bit because of the way insurance companies have started to tilt their holdings away from the longer term debt. So our suggestion is that over a period of time, um, investors will tend to find more opportunities in the short and medium term space than in the long term space.
Okay. And we also heard, separately an announcement on TCS. And if I was an investor who was looking at investing overseas through the LRS, Liberalized Remittance Scheme, does that affect me? And what about other cases?
So as far as investments are concerned, there is no change. If you are going to remit more than 10 lakh rupees, you will still have a TCS of 20%, which means that your cash flows are technically impacted. As we all know, now TCS is not a tax, it is just a cash flow impact because you can adjust it against your other taxes or claim it back as a refund.
Future taxes, yeah.
So, what is critical here is to understand that while investments have not changed, there have been changes around three specific areas. One is education, the second is for medical reasons, and the third is for travel through tours. So in those cases, the TCS rates have been brought down to 2%, which means that the government is still able to do its job of tracking these remittances overseas, which was the original intent.
Right.
But at the same time, the cash flows are now better managed through a much lower amount getting blocked. And I think that's good because so many people now have goals which are linked around children's education. You want to be treated in the best way medically if there's a situation that comes up, and you also want to travel overseas. So I think to that extent, it's really going out there and helping financial planning for a lot of clients and investors.
So that is good for people who are looking at, overseas education and medical and other such healthcare planning as well. That's great. So coming to another announcement on the buyback taxation and how that has changed, if you could, what's your take on it, if you could share?
So I think there was a distortion that came in the last budget because what happened is, buybacks were getting taxed as dividend income, which meant that for people who were in a high tax bracket, they ended up paying marginal tax rate. And that could go up to 35, 36% depending on your tax bracket. What has happened this time is that if you're not a promoter and a buyback happens, it will be taxed at the capital gains rate. So that distortion that had happened, I think, has got normalized, which I think is good news. Of course, how much of buybacks people will really participate in, etc., may be a question to really answer. But I think that this is an impact here that is probably coming up. I do think there's a bigger impact coming in another place, which impacts a lot more people, which is coming through the STT itself. Because what's happened is a lot of money went into arbitrage funds, over the last few years. And there has been this concern that has been expressed saying that, is arbitrage still relevant after the increase in STT? Our belief is that, the net impact of whatever STT increases have happened will mean that your arbitrage returns will probably drop by about 0.3% per year. And if you compare that to the alternative, which is to go to a debt if you're in a high tax bracket, you're still going to be about 0.9% per year better off by staying in an arbitrage fund. Okay. And at the same time, the new category of specialized investment funds, which are called SIFs, are probably going to get impacted by about 0.2% per annum. So I think both of these categories still remain very relevant, even though STT has gone up as far as investors are concerned.
Right. So, so that's interesting to know that the STT hike has probably marginally impacted arbitrage and even the SIF funds. Coming to the other asset class which has been in the news a lot, I know a lot of investors have been talking about it, contemplating investments or holding, or what they should do is gold and silver. And also we heard some announcements around sovereign gold bonds. So how should investors approach their gold investments? Should they look at silver? And what about if they already had SGBs in their portfolio?
So let's start with the sovereign gold bonds bid. So what has been announced is that if you buy in the secondary market, not in the primary market, then when you choose to sell it either in the secondary market or on maturity, you will end up having to pay a capital gains tax of 12.5%. The tax-free status of an SGB will only come if you bought it in the primary market and you hold it to maturity at the point of 8 years. What it's meant is that for most people, the tax is now going to be 12.5%, which is how it is for physical gold, which is how it is for ETFs, which is how it is for a gold, um, you know, uh, fund of funds using an ETF as an underlying on a long-term basis.
With
So
the
this is
added benefit of getting some interest.
that's right. So SGBs still have the benefit of a 2.5% interest, but the taxation has got equalized, and that's what I mentioned earlier on as well. That one of the things that has happened in the last budget as well is trying to make all of these tax things simpler by having standardized approaches being taken, and we think SGB taxation is a step in the same direction. Though obviously it's not very popular because a lot of people were probably not aware that if you buy in the secondary market, you don't get a tax-free maturity benefit, which is why a lot of people were buying at premiums, ranging anywhere between 5 to 12%.
Also,
And at the same time, there has been no primary market issuance since Feb of 24. So it's been a long while since there's been no primary market issuance. So people can't actually participate in a primary market issuance in the sovereign gold side.
Got it.
Coming to gold and silver itself, our belief is that these two have different roles to play, though they're both precious metals. Gold is that hedge in your portfolio against all the geopolitical stuff that's happening, dollar debasement, dollar de-dollarization, as people are talking about, etc. And silver is out there playing two roles. One is it's like a sort of a sister to gold, and it's also got industrial uses.
Yeah.
Now, the characteristics of these precious metals are very different from each other because silver is much more volatile, goes up, goes down much more, etc., as compared to gold, which tends to be far more stable. So our belief is that in the last few days, what has happened with the sharp corrections in gold and silver is that they have demonstrated exactly this sort of characteristic that they normally have. I think when they were going up, somehow people believed that the system has changed. That suddenly silver is now going to be this always going up precious metal. Our belief is what you need to do right now is ask yourself saying, how do I want to run my gold and silver strategy? I'm a long-term investor. Do I want to have silver in spite of its volatility? If I want to have it, I need to have it tactically and for smaller amounts. Gold can potentially, because of the geopolitical disturbances over the last 12 months getting even larger, may find a larger place in a portfolio, but you need to be very careful that you expand this exposure gradually rather than through lump sum investments, because timing this asset class is going to be as difficult as timing equities or other volatile asset classes, and you want to therefore go in gradually.
Got it. That was great. So finally, the question that we again come to is that one of the other things that investors have seen is the rupee and how it has been the recent weakness. What would NRIs be having to look into given the recent rupee situation?
So I think there are two classes of people who are very worried about the rupee depreciation. One is clearly NRIs. The second is people who have financial goals which are overseas in education, a medical need, travel, which they do ever so often overseas. I think all of these people don't enjoy the rupee actually depreciating.
Depreciating, yes.
But I think we need to separate it out. As you can see from the economic survey as well, the macro situation in India is good. So it's more, in our view, technical issues that have got highlighted during the rupee depreciation. If you look at it on a real effective exchange rate basis, which is the RER, the rupee is probably valued at a much higher level than the 91, 92 that it's been seeing in the more recent past. And as the India-US trade agreement reaches its logical conclusion, at some point, whenever it does, you do expect that there will be some movement back of the rupee to its more normal level. Now, the thing with a rupee depreciation model is that over a period of time, you might see two things happen. One is either the rupee appreciates back to its fair value as per RER, which is anywhere between 85 to 88, or it goes through a long period where it just remains where it is, so that many more years of depreciation have already been captured in advance. So I think in either case, we believe that uh, the need for investors to not panic over the condition of the rupee is very important, because they could be exposing themselves to making wrong decisions. For example, they could say that, I want all my assets to be in dollar, and find that the dollar itself starts to get devalued. Or they could start to say that because international investments have done better and the rupee has weakened, I should build my entire portfolio internationally. I think these are classic mistakes that happen, because these are when the principles of asset allocation really get tested. How much of gold, silver should you have, because that could be a bit of a dollar hedge. How do you look at international exposure in your portfolio? How much of India exposure do you need to have? I think all of this will get tested, and therefore we believe that this year will continue to be one where portfolio design coming out of asset allocation strategies will be very, very important.
Wow, that's great insights. To sum up today's video podcast, I think what we understood from Vishal is that there is no need to be concerned. India is in a good macro position. Uh, yes, there have been some budget announcements which had some market reactions. What we are saying is that there is no major portfolio overhauls that we see. However, we are also saying that yes, we need to have the importance of asset allocation, whatever you're doing in terms of rebalancing, maybe moving from equity to fixed income or moving to gold or silver. Be mindful of how it connects with what your overall asset allocation is, and be mindful on rebalancing your portfolios. So thanks, Vishal,
Thank you
and
so much.
we hope that our investors like this video podcast.
Thank you.
Disclaimers. Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of BUSL and certification from National Institute of Securities Markets, NISM, in no way guarantee performance of the intermediary or provide any assurance of returns to investors. The information is only for consumption by the client, and such material should not be redistributed. The securities quoted are for illustration only and are not recommendatory. This material is for information and educational purposes only.